If you and your spouse are behind on retirement savings, there's a strategy sitting right in front of you that could unlock up to $65,000 in tax-advantaged contributions in a single year. Most couples never use it, not because they can't, because no one told them it exists. Here's the problem with waiting. Every year you don't use these accounts is a year of tax-sheltered growth you never get back. The IRS compounds that cost for you. According to Fidelity Investments, a couple both age 55 who maxes every available catch-up account for just 5 years and earns a 7% average annual return can generate over $100,000 more in retirement wealth than a couple that starts at 60. That's not a typo. 5 years of delay carries a 6-figure price tag. This video will show you exactly how the spousal catch-up strategy works, what accounts are involved, and how to build the full stack before your window closes. The spousal IRA rule. Most people skip. Let's start with the piece that surprises people the most. You do not need earned income to contribute to an IRA. Not if you're married. Under the rules governing Section 408 of the Internal Revenue Code, a working spouse can fund an IRA for a non-working spouse, as long as the working spouse has enough earned income to cover both contributions. This is called a spousal IRA, and it has existed for decades. But according to the Investment Company Institute, only about 13% of households contribute to an IRA at all. The spousal version is used even less. Here's what that means in 2025. The standard IRA contribution limit is $7,000 per person. But if you're 50 or older, you get a catch-up contribution of an additional $1,000. That brings the limit to $8,000 per person. For a married couple where both spouses are 50 or older, that's $16,000 total, one for each spouse, even if only one person has a paycheck. Now, income limits apply if you want the Roth version. For 2025, the Roth IRA phase-out for married couples filing jointly starts at $236,000 in modified adjusted gross income and disappears completely at $246,000. If you're under that threshold, the right move is to use Roth accounts here. Tax-free growth in retirement beats a deduction today for most people in this situation. Your tax bracket in retirement is what matters, and for most late starters, that bracket is likely to be lower than you fear. But the tax-free compounding on a Roth still wins. If you're above the Roth income limit, the traditional spousal IRA still works for the tax deduction, depending on whether either spouse is covered by a workplace plan. The deduction phase-out rules for traditional IRAs are different, and your filing status changes the math significantly. The IRS publication 59MA has the current thresholds. Check them before you file. Stacking the 401k. Catch-up. The spousal IRA is the foundation. Now let's build on it. If the working spouse has access to a 401k, 403b, or 457 plan at work, 2025 brings a meaningful upgrade. The standard 401k contribution limit is $23,500. Workers aged 50 through 59 get a catch-up contribution of $7,500 on top of that, bringing the total to $31,000. That catch-up figure comes directly from the IRS and applies to most employer-sponsored plans. Here's where it gets better. Secure 2.0, passed by Congress in late 2022, created a new super catch-up provision for workers aged 60, 61, 62, and 63. Starting in 2025, those workers can contribute an additional $11,250 in catch-up contributions instead of the standard $7,500. That pushes the 401k maximum for that specific age band to $34,750 in a single year. If you're in that 60-63 window, that is not a detail to gloss over. That extra $3,750 per year, compounded at 7% over 5 years, adds roughly $22,000 to your balance by the time you reach 68. The data is clear. Use this provision if you qualify. Now add the spousal IRA back in. A working spouse maxing a 401k with the age 60 super catch-up, $34,750, plus funding 2 spousal IRAs at $8,000 each, brings the household total to $50,750 from these 2 account types alone. That's before we talk about the third layer. One important caveat: your ability to reach these limits depends on your employer's plan rules and your household cash flow. Some 401k plans have their own contribution percentage limits. A plan document review or a quick call to your HR department will tell you the ceiling specific to your situation. The HSA. Nobody talks about in retirement planning. Health savings accounts are the most underused retirement vehicle in America. I research retirement strategy for a living, and the number of people who treat HSAs as a use-it-or-lose-it flex spending account, rather than a tax triple-advantaged retirement account, is one of the most expensive misconceptions I see. Here's how an HSA actually works in retirement planning. Contributions are tax-deductible. Growth is tax-free. Withdrawals for qualified medical expenses are tax-free. No other account does all 3. According to Fidelity's 2024 retiree healthcare cost estimate, the average retired couple at 65 will need approximately $165,000 to cover healthcare costs in retirement, and that figure does not include long-term care. An HSA is the most efficient vehicle for building that reserve. For 2025, the HSA contribution limit for a family is $8,550. If either spouse is 55 or older, there's an additional $1,000 catch-up contribution per eligible person. If both spouses are 55 or older and each has their own HSA-eligible plan, that's a potential $10,550 for the year combined. The eligibility requirement is the piece that filters people out. To contribute to an HSA, you must be enrolled in a high-deductible health plan, what the IRS calls an HDHP. For 2025, an HDHP is defined as a plan with a deductible of at least $1,650 for self-only coverage or $3,300 for a family. Not every employer offers one, but if yours does, and you're currently in a traditional low-deductible plan out of habit, that habit is worth re-examining. The right move here is to treat the HSA like a retirement account, contribute the maximum, invest it in low-cost index funds, and don't touch it for current medical expenses if you can afford to pay those out of pocket now. Let the account compound. After age 65, you can withdraw for any reason without penalty. You just owe ordinary income tax on non-medical withdrawals, making it functionally identical to a traditional IRA at that point. Putting the full stack together. Let's build the complete picture for a couple where both spouses are 62, one spouse works full-time with a 401k, and the other is not currently employed. The working spouse maxes the 401k at the super catch-up limit, $34,750. Both spouses fund their IRAs at $8,000 each, $16,000. The working spouse is enrolled in an HDHP and maxes the family HSA with both catch-up contributions, $10,550. Total household contribution for the year, $61,300. Now, shift the scenario slightly. If the non-working spouse has any self-employment income, freelance work, consulting, a side business, they may qualify to open a SEP IRA or solo 401k. A solo 401k for a self-employed person allows up to $34,750 in contributions in 2025 for someone aged 60 to 63, subject to net self-employment income limits. Even modest freelance income can unlock a meaningful additional contribution. The math changes dramatically based on net earnings, so this one requires a closer look at your specific income picture. The headline figure of $65,000 plus is achievable. It's not a theoretical maximum built on edge cases. It's a realistic target for a dual-account household where both spouses are in their late 50s or early 60s and one has access to a strong employer plan. My take: if you're in your 50s or early 60s and you haven't mapped out this full stack, you're almost certainly leaving tax-advantaged space unused. Start with the Spousal IRA. It requires no employer, no special enrollment, and you can open one today at any major brokerage. Then add the 401k catch-up. Then evaluate the HSA. Build the stack one layer at a time. The income thresholds, phase-outs, and HDHP requirements mean this strategy looks slightly different for every household. Your tax bracket, filing status, and employer plan rules all shape the final number. But the structure works for the overwhelming majority of married couples in their 50s and early 60s with at least one earned income earner. Disclaimer: I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. If this strategy is new to you, the best next step is running the numbers with a fee-only fiduciary, someone who is legally required to put your interest first and doesn't earn a commission on what they recommend. The National Association of Personal Financial Advisors, NAPFAA, has a free advisor search at napfaa.org. If you found this useful, subscribe to Money After 50. We publish every week specifically for people who are building retirement savings later than they planned. And there's no shame in that. There's only strategy. Drop a comment below with the retirement topic you'd most like me to dig into next, whether it's Roth conversions, Social Security timing, or something specific to your situation. I read every comment and it shapes what I cover. Next week, we're tackling one of the most urgent Social Security questions I get. Should you claim early because of the projected 2033 trust fund deadline? I'll walk through the actual math so you can decide for yourself. This video may contain affiliate links. I only recommend tools I use personally.